Okay, good evening, guys. Welcome to another live trading clinic. My name's Steve Ruffley. So today we're going to focus on the Fed. So really the final bit of major news, I guess, for 2014. An interesting one again today. It's so hard to predict what the FOMC, not what they're going to do, because generally we've priced that into the markets and we know, but it's more the language that comes out. It's more about what the Fed don't say than do say. When you talk about interpreting, the minutes, you talk about interpreting what happens after an event or a non-event. It's all about being almost like a detective, trying to figure out the tone of language, how the slant's changed. Remember, people, traders, institutions will be looking for what's said or not said today and the way it's phrased. In order to make decisions in the future. So we all know that interest rates are going to go up at some point. It's not, if, it's when. But this language that's used today will help us really kind of interpret that and see when that could be. So I'll go through what's going to be expected in a little bit. I'll just go through the short presentation. And then we can, any views you've got, just let me know and we can talk about that. Then we'll go through any products from a technical perspective. We can do that also, and then we'll again get ready for the announcement, the language afterwards, and put some trades on. So it might be that, well, it probably is very, very unlikely rates will change, but that's not where the money's made. Plenty of times we've traded the FOMC this year and made money, and it's been unchanged. We've known, but the markets have moved, and we've made some money based upon the rhetoric and commentary that's been said afterwards. So definitely an opportunity to make money. I've been saying for a long time the UK will be first to move on rates, and they will be. So I'm concentrating solely next year on FX Street, on the Fed and the Bank of England. So again, it's going to happen, and it's such a big focus point because we're moving out of this growth cycle into the inflationary control by interest rates. But I'll talk about that as well in a minute. So before we start, as always, this morning, remember that spread betting and CFD trading carry high risk or capital can result in losses that exceed your initial deposit. It might be suitable for everyone, so please ensure you fully understand the risks involved. The information provided here under no circumstances offers consideration to invest. Nothing here should be investment advice. The information provided is believed to be accurate to the date it is produced. Again, education only. Content webinars, personal opinion of the moderator on intro.com. Content does not constitute financial investment or tax advice. Intro.com does not accept any liability of the content of the consumer during this session. So we're going to cover live charting analysis. So I'm going to go over the charts in real time. Remember, my view is that markets move 80% of the time technically, 20% of the time fundamentally. This is a prime example. The market will move today if something's said or not said. That is based upon fundamental information. It will move between technical boundaries, which is technical analysis, our support, our resistance. Multiple time frame trading, again, I've got time, I can do that, but it's really just looking what's happened in the past to predict the future. Fundamental analysis, but again, we'll delve into the preview of what expected from the FOMC and what's not likely to be said and what is likely to be said and how we can trade and make money from that. I've got the account open, so I'll do a live trade, of course, if I see anything good. And Q&A, it's down to you guys. You can get what you want from these sessions. Your questions are entirely up to you. It can be fundamental, it can be technical. You can ask me anything. There's nothing I can't give an answer to. So I'm going to focus on the euro, dollar, gold, and the S&P 500. But a resurgence in the S&P 500 prior to this meeting. We've seen a little bit of a sell-off now, but in anticipation, it looks like the market's expecting the Fed to be quite accommodative. So we've seen a bit of a sell-off in the indices, but we're still hovering around 2,000. So it's certainly not game over for the indices just yet. With all the troubles in Russia, all the troubles with oil, where do these rich 1%ers put the money? Well, it's going to be places like the S&P, the FTSE, stable currencies. So gold might see a bit of a resurgence. But realistically, I see the same pattern in gold as I do in oil. And oil's got a lot further to fall before we find some significant buyers. It is an elastic demand, so I think there's some big power plays going on. But again, you can look at all these things however you want. What Dubai's economy's been hit, 33% in 30 days. Russia's ruble and the economy's gone into free fall. Goes to show when you mess with the West, who's going to win? We can't go and invade Iraq, Iran, Russia. They're too powerful, but we can destroy them with sanctions. We can destroy them with money, and that's exactly what's happened. So there's no real reason behind this. It's mainly political, and it's the world markets doing what the world markets do, exploiting fear, exploiting people's inability to see the future and take risk. So it's going to be interesting. It's going to be an interesting start to 2015 because Russia's got some major structural problems, and Putin controlling the media, being able to still put out when the ruble's dropping like a stone how popular it is in Russia. These things, like anything, will just repeat. History repeats. And we get these ridiculous points of hyperinflation, and by the time you've queued for a loaf of bread, you already can't afford it. These things won't be tolerated in the modern world. and Russia, although it's still Western. Again, there's a massive gap between the rich and poor in Russia, and even the poor people won't put up with this. So big shifts and big changes in that regime. So I guess the FOMC today is all about what's not going to be said. So I think we're trying to look for this kind of dovish stance that the Fed are going to support the US no matter what. Now, obviously, we've put all this money into the economy, these trillions and trillions of dollars of quantitative easing, and that's stopped now. So what we're looking for really is the FOMC to maintain the 0 to 0.25 target for the Fed's fund rate and emphasise all these things are data dependent. What we're looking for is them to change or remove this considerable time message. So it's going to be a considerable amount of time we'll support the economy. Because when we remove that considerable amount of time, that means we've got room to manoeuvre on interest rates. So it's not what will be said. The Fed will not come out and say we're going to move on rates third quarter 2015. They never do that. But they use this language, this rhetoric, this terminology to give this smokescreen, and this is what you have to interpret. So really today they say that it's not going to be a considerable amount of time that we're going to focus on the Fed's fund rate. Well, that means that interest rates are going to go up sooner rather than expected. So interest rates go up, then the dollar's going to strengthen, but the S&P is going to weaken. That's what we're looking for today. So it's going to be an interesting mix really, because I think that third quarter is pretty realistic, and although we keep getting this mixed message from Mark Carney and the Bank of England that when interest rates are going to go up or not. He needs to stop this housing bubble. He needs to stop the rot in London, and he needs to normalise the economy. The big thing for me is because we're moving out of this growth cycle, so less focus on job creation, that bump on non-farm payroll figure earlier this month, and less about the GDP growth. It's going to be small, but it's going to be ticking along. It's going to be growing. So we're just going to stop focusing on the growth and move to inflation, which is all about interest rates. However, we've kept interest rates historically low artificially. So we don't really know what inflation is or what it's meant to be. It's just a byproduct of the economic situation. So we don't really know what interest rates are going to do to inflation. All we do know is inflation's carried to go up, but all prices have carried to continue above inflation, but wages haven't increased with inflation. So net, although prices for your house has gone up, your real cost of living has considerably gone up. Okay, people are celebrating because petrol's a bit cheaper. So what? People have already priced that kind of stuff in. People have used different means of transport. People have cut out their excess journeys. The real price of living increase is going to come when we put rates up, because I don't know anybody, well, apart from me, who doesn't have any debt and doesn't have any mortgage. So, there's lots of people out there that a small increase in debt or the debt burden is going to make a real significance in what people can draw down and actually pay. So looking through a technical perspective, start with the S&P. I mean, again, you don't have to be a genius to see the trend is down. But we look back to the monthly chart, and again, I just fail to see that this rally in the markets is over. You wouldn't draw a trend like this in the monthlies this steep. You just wouldn't. It just isn't good technical analysis. But this is where we are. Markets are aggressively buying every low. So, okay, we had this big false breakout, a couple of months back, but we bought all that back. So we're just naturally, getting back to this upper aggressive buying cycle. So really, as long as we kind of stay around these levels and don't go too far down, then the market's going to make new highs. So you just filter that through to your weeklies. Again, still looks pretty strong to me, to be honest. Indecision if we close here, going to make new fresh highs. Where are you going to put your money? What, in Greek debt or Google shares? Okay, I know where my money is. I know where I think it's safer. It's not with the Greeks. So back to your dailies. Again, on the bottom of a cycle, but, nice little bounces here. Starting to look clearer, isn't it, that the market's still got some room to rally. So we just look at the hourlies right now to focus on what the S&P can do. So again, we're kind of mid-range to where we have been. But any increases, we're certainly going to see above 2000, 2011, 2023. Gold, same kind of scenario. Look at the monthlies. Again, I'll just put it on a blank chart to show you the old time frame method of trading. Up move started from here to here. Where's that 50%? Okay, 50% is here. So we're still well below it. So we're bouncing off the 61.8. But if we fail to get back to that 50%, we make new lows. And it's going to hit $1,000. 2013 of September, I quoted this was going to happen by this time. So I'm a little bit off. But you know what? It's closer to $1,000 than it is closer to 1,900. So, again, back when I was quoting up here, I anticipated this big drop. So here's your margins. Here's your stop, 103.02, and then $1,000 for your profit. Once you break $1,000, it's anyone's guess. Could be $500-600 by 2016. But again, we'll have to see. People say these things can't happen, but they do. They happen all the time. Oil's dropped 50%. Yeah, so anything can happen. easily and in a very short period of time. So gold, again, just go back to the hourly chart. Really see that it's tried. Gold. All the analysts are saying the hedge funds are getting back in to push the price of gold up, but I just can't see it. Look at the hourly trend, the monthly and weekly, and it's still looking fairly negative. So I would say it's going to take a massive, kind of massive push still to get gold, get the bulls back into gold and get the investment back into gold. I just think it's gone. So really, for me, it's all about selling these high points in the trend and looking to get back to the lows and, $1,000. That's the key target point. Once we close finally below, 1,700, 1,600, that $1,000 will not take long to get to. Trust me. Euro dollar, as I've always said, sell highs in the euro dollar. It's finished. It's just finished. It's simple. Lower high, lower high, lower high, lower high. How many times have I said this on FX Street? Literally too many times to mention. So just look at the simple trend here. Lower high, lower high, lower high. Market's going to break these lower levels here. When it does, it's finished. It's going to get to, 1.098. And then who knows? Who knows how low it's going to get? It's in real trouble. And it's as simple as that. The charts are telling you, screaming to you that, the market does not want to hold on to these highs. So consolidation after this heavy number of weeks of selling. I mean, that's ridiculous. Every opportunity to bounce back here on this weekly hammer didn't hug these bottom Bollinger Bands. So looking to get lower, so nothing's going to save the euro. Okay, dailies, same kind of scenario, lower highs in your days. And again, getting quite aggressive. You wouldn't really draw lines this steep, so we've got a chance here to bounce up and maybe have a little bit of relief rally. But once we get below this trend line, then 1.2, 1.16, all these key levels and these monthly levels are coming back in. 1.20, 1.18, 1.16. It's all where the market's been in the past, so we can go back there in the future. That's just how technical analysis works. So looking at the the figures today, I would expect a strong FOMC, anything supportive, sends the euro dollar further down. So key levels down here, we'd look to reach pretty quickly. We could easily break these two levels and get down to 1.22322. Anything positive, again, I see a drop in gold. And anything positive, we see the S&P get back up to these upper levels here. 2.3300 is a big level here, trying to get back in these hourly fibs. All right, guys, we've got 3 minutes or so before the figure. So what we're looking for is what the Fed don't say. So it'll be unchanged, as pretty much 94 analysts have said on across the board. Only 4 have gone for a change here, but it's very unlikely to happen. So we don't need to focus on that. We need to focus on what the market wants to tell us by the rhetoric that's not said. So wait for the call, wait for the movement. Any kind of final questions or anything anyone would like to ask, guys? Okay, we've only really got a minute or so we'll leave the questions till afterwards. But really watch for this market action. I'm going to keep the charts on the hourlies and switch to a smaller time frame. These are all our boundaries are here. So again, anything positive, we see the euro again lose against the dollar. We see gold again go negative and the S&P go up. All right, Carl, so we'll go through the dollar yen, but the dollar's going to strengthen on any positive news. So buy on any strong news, any positive dovish comments. So remember, the call is unchanged. So we're not expecting the headline. We're just waiting for, anything to be said afterwards. So, all right, guys. So remember, it doesn't have to be anything in the headline. It's all about the comments. What's that weakness in gold? Okay, guys, just a minute now. So, again, watch for any pre-market action. See if there's anything interesting. Looking for a big spike down in gold with a positive and a nice bound up in the S&P. Keep one eye on the euro dollar as well. Again, remember, be patient. Do not jump into these. $15 seconds, guys. Get ready. Watch gold. They've dropped the phrase. They've dropped the phrase. Okay, so they've dropped that phrase we were looking for. That considerable amount of time. Okay, so that means interest rates could go up. So watch for any kind of sell off in the S&P, and watch for any strength come into gold. So just listening through the figures now, guys. I'll tell you about anything important. So they haven't mentioned recent global growth stability. So Mark's taking this well. So watch the S&P. Watch this level up here. 2012.40. That's our next target. So any longs there. Watch for the turn there. Gold's getting negative. So breaking 1119.20. Next target for a lower move down will be around this fib level here at 1186.01. So pretty much the Fed fund rates are expected to be fine. The general kind of consensus from this meeting is that it's all generally good news. So short-lived sell-off in gold, but I mean, again, be patient, because the market might quickly try and push any shorts out and go up. It's in a tiny little bid in the euro dollar, so a bit of strength against the dollar, but nothing to write home about. Again, we've not quite got to that 211.55 mark in the S&P yet. So GDP 2.6 for next year. So unemployment rate 5.2 to 5.3. So again, fairly positive figures out of the Fed for next year's forecast. So gold's reversed now and getting back to this 50% pivot. So see what gold does here. We could see a bit of a short squeeze where gold hits up to these upper levels and maybe pushes any shorts out of the market very, very quickly. Still a bit of a bid coming back into the euro dollar. So again, we expect if it is going to push up, the moving average and really 1.24895 would be a level to perhaps sell back down. Seems to be good news across the board here, or positive, dovish comments. So again, watch for gold starting to get any rally now and follow the S&P. Again, these inversely correlated. So it might be a sell of gold at these upper levels here. Maybe 1204 spot 70. So again, we're getting up to these upper levels now in the S&P. So just watch for the market, see how we react around these upper levels. So inflation expected to rise gradually to 2%. So nothing unexpected there. So moderate pace expansion. So again, all good news. So that spike in gold is a bit of a short spike. So watch the 5-minute candle on the on gold, and you can see how the market wanted to sell off, but is now pushing to these upper levels, this upper level fib here, and get all the shorts out. There we are. So the market's just bipped across that target that I said of 212.40 in the S&P. So the next level where the market could find some sort of resistance is that good level of 2022 spot 20. So again, looking to go negative in gold now. So again, we've got trying to squeeze very, very short term all them shorts out of the market. Again, by pushing the market up on this good news and expecting the market to come down. So again, remember gold and the S&P are inversely correlated. S&P should go up, gold should go down. So we just broke above that level in the euro dollar. Again, I put us on the smaller time frames just so we can see how the markets are reacting. Because again, once the first 5-minute candle closes, we can do perhaps a Fibonacci or see how the market's going to react. So again, a nice one in the 5 minutes on the S&P, because like a nice big level. So you could say that's probably going to be the low and the high now. So what we'd expect, draw your Fibonacci in the opposite direction and look for that 50%. So your 50% is here at 2005 spot 35. So the market is going to hold above that level and the next candle open and make a new high and probably get to these next daily, weekly levels of support at 2022 spot 20, or maybe this next fib. So again, looking for negative in gold now. You expect gold really to come off on that good positive news. It's pushed everybody out now, so should really have sold up higher, but you can't always get it right. Gold's coming off now, so gold, I would really say, again, we'll just put the fib on gold as well. So the pivot is here, this 50%, this upper level. So once gold kind of hits below 119, well, there we go, it's just gap down. Look at gold really going for it now. Gold's really going to lower levels here, 1190.05, then below that. Okay, so short squeezing gold, as I said, pushing all the players out, and then gold has quickly turned and reversed and tried to find these new lows. So again, hold above 2005.35 in the S&P would be a good buy for this market to make a new high. And the 50-cent pivot in the euro dollar. Again, I'm expecting that to get smashed as well because the euro should be weakening on that positive US data. So again, sell anywhere now for the euro dollar, to be honest. In fact, I'm selling the euro dollar now. So to sell a little bit of euro dollar, just anticipating that this is going to move lower. Again, we've gone quite a long way down today, so I'm not expecting huge moves, but it should really move down, a little bit. Gold's going to start to drag down. Probably see a buy, maybe a buy in the 50% in the S&P. So see how we do when we hit 2005.35. So gold hitting these lows now. So if gold could get really smashed down, we've got a long way to go in gold. So if there's good news, so if we break down, we could easily see another 60, 70 ticks in a short in gold. Okay. Stops on euro dollar is just around that 50%. If we don't start making lower and break these lower Bollinger Band type things, then I don't really want to stay in this trade for any long. It's just a short term push down I'm looking for, and maybe make a new low down here. So my stop really is not far away from my entry point at all. Really, maybe 5 ticks. So gold's moving down now. Gold's moving down. So what that aggression's coming now. I want to see gold just hitting these lows, pushing it all out, and we're looking again getting down to these lower levels. Could see a nice move in gold now, and that could tie in with buying some S&P. So the S&P could just hold in that 50%. Might be another cheeky little trade. So at 2005.35 in the S&P, could be a little bounce off that intraday 5 minutes. So we could do with gold hitting these lows a bit more, and the euro find a bit more weakness. And this could be a nice little trade setup. So gold, we want to see it really attack these lows. Okay, we could easily jump 20, 30 ticks. Yeah, so gold was really a good short. Really a good short. Should have got short a lot higher. But there you go. So, yeah, euro dollar's just kind of mid-range now, back to that entry point. So we tried to move that and gap that lower. So it could be a squeeze here. So I might want to get out of this euro dollar. It's not looking particularly great. Again, I mean, these 5-minute charts and 5-minute candles are not really how I like to view the charts. I like to view them the hourlies. But for the purpose of this presentation, there's a big spike down in gold there. Some big block chunks being taken out. So we didn't get quite as low as I thought. You only did 37 ticks, not the 70. But, again, good opportunities to get profit out. Remember, on the 5-minute charts, it's difficult. So get to that for that 50% now in the S&P. So 50% is just touched now. So that could be a good buying point in the S&P. So we'll see. Again, if we break through, then again, it's not going to be a prolonged trade. So we'll just see how it reacts now. So again, getting down to the 50% on the 5-minute. So we've only really going to take on a couple of ticks of risk just to see what the market wants to do here. So 17 ticks to make, maybe 94 ticks to make a new high. So that could be a good low in the S&P just here. So again, just a lot. It's difficult to watch it on the smaller time frame charts because you see the movement, your profit and loss going onside and offside. But you've got to think where the market's going to be in the next 15, 20 minutes, half an hour. It depends how long you're going to hold your trades for. So again, if we start breaking below 2004, then maybe again, if for a short term scalp you want to get out. But it depends how much market access you've got, how quick you are. So kind of back to indecision point, that 50% in the euro dollar. So not worrying too much. Big move down in gold. Again, a good 67 tick move down before big players came in and took it out. But, again, it gets very, very difficult, doesn't it, to kind of understand, what the market's going to do in these 5-minute charts. If it's a 15-minute chart or an hourly chart, you generally get a much clearer idea of what can happen. So the Fed have basically said they're going to stand by the markets. The inflation figures look good. The employment figures look good. The Fed funds rate looks good. They removed the considerable amount of time, which means that interest rates, could be moved quicker. So again, I don't understand why we're seeing any kind of euro strength on the back of that. But again, I think it's just the market's being pushed up slightly. So again, seeing gold just hovering back down, when it gets to this bottom level, 118.95, then really, again, we should see the market start to retest these lows. So if we've held above the 50%, so that might be retested again from a technical standpoint. And if it does, the more it holds above it, you expect the S&P to perhaps make some new highs on the back of this good news. So when the market's rallied, and is long here and is long here on the back of that, relatively positive outlook after these, period of selling, days that we've seen. So what we're looking for now is the market to get back up. So we're really hovering, really kind of indecision. Look how that 50% is working absolutely perfectly. The market's thinking, is this a place to buy? Is this a place to make that new high from? A good place to springboard off. Gold again, technical. Got back to that last point, so might hover here, and then again retest and move a little bit lower. So really it was all about what the Fed didn't say, okay? The Fed didn't say that anything particular about growth, anything particular about unexpected things happening in the economy. So they removed a considerable amount of time saying they're going to have to support the economy. So they're thinking the economy should be self-supporting, again, from early 2015. So these are all positive things, but however, it does mean rates, might rise sooner than people expected, which will be a net negative thing. But again, because rates have been so low, we don't know. We don't know what rates are really going to do to the world, do we? I mean, in my opinion, nothing good. But again, the markets and the world is self-supporting and move without quantitative easing and can trade normally, that has to be a positive thing for the global economy, doesn't it? It has to be positive. So again, just getting back to the fib levels in gold. So again, just towards the bottom of the range, but we've had this big push out here, so I'd still expect this candle to go green. Touched that 50% perfectly at 2005 spot 35. So you'd expect from here the S&P to make new highs. You really would. I mean, it'd be surprised if it doesn't, get another 50 ticks, and hit this high, because it's got nowhere else to go. Euro's still being a pain and pushing higher, only trading a small size. So I'm just going to hang on to that for the time being, because I don't really see it as a particular problem just yet. Because again, I'm very, very negative the euro anyway. So I think any positive news really has to send the euro down against the dollar. So S&P now, again, making all the calls, just not in the right markets. That's the way trading goes sometimes. But we're just looking for these highs to be hit back in the S&P. And you expect when we get to this level up here at 212.40, we've got to make that few pips higher to make the higher high. Might only make you by 1 pip, but you'd have to say from this point, and we've bounced off this 50% time and time again, absolutely perfectly. So real retracement in gold. Okay, so you've got to keep your wits about you. So gold really is reversed from these lows and dip back into the range. Okay, it's just a headline coming from Reuters. The Fed are cautious on. I'm talking about when they're going to normalise rates. So maybe that's a reason why gold's just spiked back up. So they can wait a considerable amount of time to raise rates. That's what the news has come out. So that's why we've seen this big reversal in gold. No move in the S&P now, which is strange. But we've really taken a hit on that euro. Okay, so that's probably what's affecting the market right now in this reversal is this comment that comes out in Reuters. The Fed actually can wait a considerable amount of time. So it says, I don't believe that. I don't believe that at all. But that isn't good for our position right now. But going to have to hold tight and see what the market does. If it makes a new high from here, probably going to get out or maybe average in. Again, gold's made this big reversal now. And the S&P's done nothing. I'm not sure why that hasn't moved, to be honest. That doesn't look right to me. But I think anything for the S&P is going to send it up. So the S&P really should have been the trade off that 50% to make that new high. But we've seen that big reversal in gold and big reversal in the euro dollar. So it's going to be difficult to hold on to this euro dollar because of that comment. Not really because of what came out of the Fed, because of what's said. So gold, wow, gold really taking an aggressive reversal here. So very, very aggressive move here. So we're just holding on the S&P now. We're just waiting. Gold's going to have to make a new high. It might push up to 1207 from this point. If it makes a new high, we don't know. I'm selling more euro dollar. There's no way on earth this euro dollar staying up. So I'm averaging in. I'm going to stay in this trade for the time being because I'm not buying that comment for a start. So anyone now that was short gold is out short term. So gold has every right, I guess, on them comments, be them verified or not, to maybe move another 60 ticks before he gets back to the range. So euro dollar, again, spiking up, not doing us any favours here at all. So I'd say gold probably easy another 61 pips to push all these shorts out and then some more before then coming down. S&P's really had no reaction at all. It's not done anything, which is fairly unusual. So there we go. I mean, it's one of these things about these FOMC minutes. They're never exactly as they think, are they? Nothing's happened in the actual rates itself, but it's the comments that come out that really do, hurt the market or confuse the market. So we've come out with dovish news. The market has done exactly what I said. Gold made new lows. S&P went up, but for whatever reason, the markets have decided to take this extra comment that came out and was printed on Reuters to say that the Fed can wait a considerable amount of time to push the euro up. But I've averaged in towards the top. And I'm staying short because of my fundamental views, and I just believe that the euro's got no right to be a further them comments. So a big triple top in gold, so quite unusual. So you expect gold, maybe it's technically trading now. Maybe I get back to the 50%, so 1195.82. Kind of holding on the S&P towards the top, but you expect the more it holds above that 50% and the 50% this time frame here, we've really kind of got to move and make that new high. So squeeze another 20 ticks up and maybe just pip up to 2016.25. So this again, when the markets are quiet, the markets don't have that amount of volume through them. They can be very volatile. So it's not normal market conditions. With very relatively small size, you can make the markets move very, very quickly. That's why I always keep an eye on gold. Because gold is just so heavily traded by huge traders and banks that they can do whatever they want. So really, the market's not done that much, but it's moved in the last 15 minutes, 150 ticks. So 150 ticks up from the pivot, made three highs, one significant low, but I expect it to get back to this midpoint really, and to be trading back to the 50% where it was trading before. So all that action and nothing really 15 minutes later has happened. Apart from the traders, they can get involved, buy big chunks down here, push it up to here, and then reverse it. So that's why I averaged into that euro. So my other half of the euro trade is just coming on side now. So again, sometimes you've got to, stick to your wits and, understand that fundamental data just moves the markets very, very quickly. So you have to be able to adapt and you have to be, quick in your trading responses. And there's no place trading fundamental data and running stops. There just isn't. It's too difficult. So you've got to make a decision based on the fundamentals and stick to it. And you're either right or you're wrong. And that's just, unfortunately, the way trading fundamental data goes. So any other questions or any other thoughts, guys? Quite an unusual move in gold. And again, quite a destructive move in the euro there. But I think really kind of looking at the high time frame charts, going from the 15-minute, really, it's got no right to be up here, so we might have to be a bit patient and hold this for a little bit longer. Again, if it starts to move to these upper levels up here, then we're just going to have to get out and take the loss. But, like I said, I only ever trade, fairly small size on these things and don't need to run stops because I can manage my size averaging in and I can hold a trade for, quite a long time. So that's just another style of trading. So the 15 minutes on the... on gold, again, hit these new lows. So good profits to be made. Again, I should have sold gold up here, like I said, but you can't always get it right. But you'd expect, again, we're holding above the 50%, back on that 61.8 on the 15 minutes. So absolutely primed to make new highs in gold, depending on what the market thinks. If the market thinks that what the Fed has said is more important than what the Fed said after, and when they said about, the Fed can hold off rates for some considerable amount of time after removing that phrase, then what do you believe? Do you believe Janet Yellen, or do you believe the comments that came out afterwards? So always rife for a bit of short-term manipulation when there's been contradictory kind of information. And that's why the market's so difficult most of the time because, who do you listen to? Who do you listen to? So really kind of holding towards the highs in the S&P, consolidating towards the highs. So the euro now has gone positive again. So it's not looking good. So it's Yellen that's come out and said he'd be patient about raising rates. So a similar amount of time before rates has to pass before rates will be addressed. But it says, they're still going to move in 2015, so it's just absolutely contradictory. Again, this is what makes it so hard to trade this data. That's just basically saying what we all know. So low inflation is transitory. The economy is set to improve. So again, old dovish comments. So yeah, they continue to moderate inflation. I mean, this is all stuff we know. Nothing here is new. So I don't understand how the market's taking this information, so personally. It said that interest rates will move for a considerable amount of time. It's not quantified it. Considerable amount of time is still 3 months in the future, or 3 quarters in the future. We didn't say it moved till late or mid 2015. So it's nothing we don't know. So the euro is still going bid here. So gonna have to make a call, a decision point where we get out of this one. So again, the trouble is, I know we're going to be manipulated around and hold above this upper Bollinger Band. So really looking for these upper levels. And, again, it's so hard when you're trading like this. And again, without a stop, it's a relatively small position, but again, I mean, it's gold's just kind of hanging around towards the top. S&P's not really doing anything, and the euro's spiking on the back of news. You already know, it's nothing. It's absolutely, so frustrating when these things happen. But I'm staying short. I'm not getting out of this euro trade just yet. So watch the S&P when it tests back again. That previous 2005 spot 35 was a very good level for the market to bounce and turn. Gold's really, again, if you're going to see it break some new highs, you could see it get to 207. We've seen everyone get short-term short, then the market quickly reversed and saw this big spike that you can see on the 5-minute charts back up. So, very, very difficult to trade gold. Again, you'd be waiting for that 5-minute close, and then all of a sudden, gold just reverses in one single bound. 106 ticks. That's either someone's very, very wrong or very, very right. So then we've got all this other kind of fundamental news, the ties between America and Cuba coming back in. I can't really see that being of any major interest to the markets right now. So yeah, difficult conditions. Just after that announcement, some contrary comments and some quick reversals. Like movement in gold was absolutely brutal. If you were short gold, then everyone was scrambling to get out on that. So it just shows you how difficult and how quickly you've got to take your profit and how you've got to have your wits about you because the markets can change literally, in a matter of seconds. So I think we're going to hit this low point again in 205, spot 35 in the S&P. So let's see how the market reacts. We're on a 15-minute candle now. So the market can't close and push, aggressively below that point it's just touched now. Then maybe we might see, a bounce back. I mean, I guess, rates aren't going to be changed for a considerable amount of time, no matter what is said now. It's all positive. It's all good. It's all positive for the S&P. So really, we should see any losses rebounding. Because no matter what's been said today, everything's positive. There's nothing bad been said. The economy's growing, employment's coming down, inflation's under control, and if it's not, the Fed are going to keep rates low to accommodate. So no matter what anyone says, all that news is good. So it's all good news. So failing to see how the S&P can hold on to any real lows. So gold's coming back again, as you'd expect, because all this news that this contrary type comment that really was very unquantifiable. What's a considerable amount of time in the world? Who knows? What a stupid comment. So anyway, that kind of made gold spike up. That's coming back down now. So watch that 50% pivot down here. Gold, again, really, it's pushed everyone to a tank. So I'm looking for the same scenario to happen in Eurodollar. Push everyone up, one more push up. Oh, I have to get out now. It's never going to come down. Then in 5, 10, 15 minutes later, we're trading down here. So as I said, guys, trading fundamental data is only 20% of your overall trading. Markets move 80% of the time in a technical manner, 20% of the time fundamental. It's very, very difficult to trade fundamental data because it moves so quick, and especially late on at night where there's less UK volumes coming through. So I'd say, it's always best to trade relatively small size and to not trade with stops. And if you have a decision, remember, I've got a lot of experience. So I'm not going to get frightened out trading, relatively small size of my account, by the short-term volatility. So I can bridge that. But it's down to you guys to set your own risk reward. You think's enough's enough because it's a difficult judgment call to make sometimes. But that's why it's always good to know your risk parameters and your overall physical monetary stop. before you start trading, because in the heat of the moment, it's very, very difficult, very, very difficult to keep that discipline, if you don't really know what your set loss is. And that's why when I trade, I trade with a physical monetary stop. If I want to lose, £100, £200, that'll be it. If I don't want to lose any more than that, I'll just get out. So we're seeing the euro now reversing a little bit. So, but what you're waiting for is that reversal to kind of happen, stall, yeah, look to mini fake out, stall, sell, then you can't get in the sell, and then you take your profit way down there. So it is going to just turn and reverse that candle in the next 15 minutes. We might have to wait a few more closes before we we get out for a scratch or inevitably take some profit with that average. So a nice bounce off that level again. So brilliant calls again. You can't knock them. 200535 is a perfect bounce again in the S&P. We're going back up. Gold again. You expect for this 50% level down here to be of key interest. So we'll just highlight that. So around about 1196.46. And gold could easily go on to make new highs because all these people will be caught short, unfortunately, because of that data. But that big upswing, that 100 tick upswing we saw in that 5-minute candle, short term, nobody's holding onto that position overnight because that's just too dangerous, just too dangerous. Gold's ridiculous. It's too aggressive sometimes. It has to be central banks or huge hedge funds involved in that because that's just too much volume going through for your average retail trader. That's for sure. Far too much. All right, guys. Any final questions? Any final thoughts? Did anybody trade gold and make any money? Did anyone trade the S&P make any money? Some good calls in gold and the S&P. Not great in the euro dollar, unfortunately, but we're not finished yet. We're not out of the game yet. Well, I'm not. So, any thoughts? Anything you guys have done? Any profit made? Any trades taken? What do you think of the overall comments from the Fed? Do we think, the US is going to remain to be positive, or is the knock-on effect of Russia oil going to have a negative effect for 2015? What's going to happen with interest rates? Oil? Well, oil's a difficult one. I think, once you've spotted a trend, it's already too late. So, unfortunately, if you're looking for a bottom in oil, you start to pick bottoms, you're going to get smelly fingers. So, I'd say when you look at Brent, the data is very, very hard to assimilate. Look at this gap here. How do you trade gold from that? We just can't. So you go on your weeklies, go on your dailies, but the more that gap remains, the more we're going to go down. So I would say I'd do a Fibonacci from the gap to the previous high point. So I think in all my analysis, we're going to break $40. I reckon, we don't kind of get to a low point in oil until $37, and that's in Brent. And a similar story for crude. But once you spot a trend, it's already too late. So we're trading below, $63 a barrel. So there's nothing to say we couldn't drop another 20. We just don't know. But I'd say be very careful of picking bottoms because it's like catching pianos, isn't it? Who knows where the bottom's going to be? The reason for oil going down is not because it's suddenly becoming fashionable. It's because it's political war. The Russia, and the kind of Afghanistan and all these oil-producing nations that are against the West. We can't kill them with weapons anymore. We can't fight or afford it. So we just kill them in the open markets. If terrorists are making $1 million a day out of oil, what do you do? Take the price of oil down. Then what happens? They don't make $1 million a day. These things are political. It's a big boys' world out there. You mess with the West. The West is still a big one. So Phil's just saying the S&P now and the 50% retracement moving up nicely. Good man. Good to see that, Phil. So again, you'd expect new highs to be made. So I don't think significant highs, but 216, maybe 2023, spot 60. Depends how long you're going to hold your trades for. Again, we're coming towards Christmas, fairly kind of weakened, volatile markets without the volumes. So quite difficult to predict what's going to happen. But I would say overall, really, it's it's one to take your profit when you can. There's no point being a hero and holding and leaving money on the table in these kind of markets because they will take them from you. Okay, so it's 30 seconds until we hear from Yellen. So let's just hang around and see what Yellen's got to say because this could have another effect on the market. So we either continue and make new highs in gold and the euro, or it just compounds everything we say, and we go on to continue to make new lows in the euro and the pound. Just waiting for any new comments, really. No, guys. So watch for any spikes. So back in the bulls and gold on the 15. Same on the 15 minute on the S&P. So we're just going to... Okay, Yellen's just coming to the podium now. So I'll try and be as quick as I can with the comments. Okay, so Eurodollar's coming down, so the average working, we're nearly there, getting towards a break-even point now. So we just need we just need Yellen to come out and say exactly what she said and put them, that spike that we saw to rest. The market should continue in the direction that we originally thought. So I'm going to be quiet for a few minutes, guys. I'm just going to shout out anything that comes through. Yeah, Tim Harsh just put Ustream, Federal Live, and the Q&A. Thanks for that, Tim. I'm listening to it on my squawk. Okay, Cyber Surfer has made some nice scalps. That's very good to hear. Well done. So really just waiting for any kind of confirmation from Yellen. Just really need her to reiterate what she originally said and clarify that secondary comment. And then it's all fine. It's all good. Okay, so go break even now in this euro dollar trade. So right to hold on, right to average, but I'm not getting out yet. So watch gold when it hits 119.646. S&P's coming down now, so keep an eye on that. S&P's really getting some traction. Okay, I've not heard anything of interest yet. So the S&P's just kind of really kind of pushed through that 50% barrier. But again, it's quickly rebounded. Gold is getting towards 119.46, so that could get hit hard. We're at the nice fib levels on that euro dollar. It's just looking for that 50% to be the pivot. So still got a little way down to go yet. So S&P quickly rebounding back to that 2005-35 level. Just want to see some of these lows hitting the euro dollar. Just want to see that force, that momentum to come back in. That's what you're looking for. The market. There we go. That's what we're looking for. Get back. Just need it to push down a little bit further. Really kind of aggressively hit that 50% level. I tell you, we're close to it now. So again, it's hold your nerve. Hold your nerve. We know we're right. It was just a spoof comment that came out. So the markets did what they needed to do. So a little bit more strength. Let's say the 50% reacts now. Okay, we're just coming up to that 50% in the euro dollar now. Okay, so I want to see it smash through. We don't want to see any bounce here. Okay, it's only a couple of pips away from it. Now just tying up with gold as well now, gold. So that's what I hate to see when you see them little blips back. I want to see every little bit of momentum pushed out of any pullbacks. So gold weighing heavy. The S&P's right back to that 2005-35. A little bit of a short squeeze. So we're just getting to 50% now. Just want to see it hit, smash through, no remorse. Okay, so don't like to see this hesitation. Want to see that force come through. Want to see, why is it resting on that level again? Because it's a key 50% pivot point. They always have attraction within the market. That 50% is so important. So I want to see it push through now. Use that volume. Get everybody out. There we go. There we go. That's how you turn a losing trade into a winning trade. Yeah? That's how you take an offside position, average in, a good, sensible level, interpret what the market is trying to tell you, interpret what the market is trying to say, let it go, average in, don't trade with the stop, get your profit out of the bottom. That's how it's done. That is how it's done. Well, wasn't my finest trade. I did make the most money I've ever made, but turned a loser into a winner. What you have to do is understand how the market works. Understand your fib levels, your 50% pivot. Understand how the market reacts. Again, S&P should go on to make new highs now, 2005-35. That stupid comment that was taken by the market of Janet and Yellen saying we're going to considerably hold on rates. It's just what we already know. That's why you have to be so very careful in what news you use. Anyway, it doesn't matter now. I'm out my trade safe. I would say listen, wait for the comments coming out from Yellen. I've heard nothing yet personally. So really, this was just an excuse for the big players to push the euro up, push gold up. I simply think gold should continue to drift down and the euro will probably consolidate and the S&P going to make new highs. Well, there we go, guys. That's the last Fed meeting that I've got on FX Street for this year. It's been another good one. Anything else you want to know, guys, get me on Twitter at Steve Ruffley. That's how you turn a loser into a winner. Euro dollar wouldn't be surprised it doesn't to make new lows, but that's why I'm not like every other trader out there. I trade my own money and always trade live, put my money where my mouth is, and that's why I'm the best at what I do. All right, guys, it's been a pleasure. Have a great Christmas, and if I don't speak to you, I'll speak to you all in the new year. Thanks to FX Street and the guys. It's been a pleasure. All right, guys, good night.